The United States Treasury Secretary just said something in public that most people heard without understanding. Scott Bessent, the man legally responsible for managing America's finances, for issuing its debt, for overseeing the dollar's role in the global economy, said that we are in the middle of a Bretton Woods realignment. Those 4 words spoken by that specific person in that specific role are among the most consequential things a senior American official has said about the monetary system in decades, not because it is alarming, because it is honest, and because the last time the world went through a Bretton Woods realignment, the rules of money changed. Completely, permanently, and faster than most people understood was happening, and the difference between understanding the change and not understanding it determined for an entire generation whether their wealth grew or quietly disappeared. I want to explain what Bessent actually said, what it means, why the US government is doing this, deliberately rather than reluctantly, and most importantly, what the structural forces at work tell us about where capital should be positioned as this transition unfolds. Not as a trade, as a framework for understanding the monetary environment you are operating inside. Let me start with what Bretton Woods actually was, because the term is used frequently and understood rarely. In July 1944, with World War II still ongoing, but its outcome increasingly clear, representatives of 44 nations gathered in a small town in New Hampshire called Bretton Woods. Their task was to design the post-war global monetary system, the architecture that would govern how currencies related to each other, how international trade would be settled, and what asset would anchor the entire system against the inflationary pressures that had destabilized every major economy in the preceding decades. The agreement they reached was built on a single, foundational principle. The US dollar would serve as the world's reserve currency, and the dollar would be convertible to gold at a fixed rate of $35 per ounce. Every other currency would be pegged to the dollar. The International Monetary Fund and the World Bank were created as institutional pillars of the system, and the United States, which held the majority of the world's gold reserves after the war, became the financial center of the global economy. The system worked because it was credible. The dollar's gold backing meant that governments holding dollars held in effect a claim on physical gold. The supply of dollars was constrained by the supply of gold the US held, which meant the system had a natural limit on monetary expansion. Inflation remained low, the international trading system stabilized. The American middle class was built during the period when this system was functioning. The 1950-52 and early 1960s were the era of the greatest broad-based prosperity in American history, and the monetary stability of Bretton Woods was foundational to that prosperity. The system collapsed because the United States violated its foundational constraint. The Vietnam War was expensive. The domestic social programs of the 1960s were expensive. The combination of military spending and social investment required more dollars than the gold supply could honestly support. The government was issuing more receipts than it had assets to back. Other nations noticed. France under de Gaulle, who understood monetary systems with unusual clarity for a head of state, demanded physical gold in exchange for its dollar holdings, which was the contractual right of any Bretton Woods member. Other nations began lining up. The resulting outflow of gold from the Federal Reserve threatened to exhaust US reserves entirely. On August 15, 1971, President Nixon closed the gold window. The dollar's convertibility to gold was suspended temporarily, he said. That temporary suspension has now lasted 54 years. The dollar became a fiat currency backed not by a physical asset, but by the credibility of the US government, by the depth of US financial markets, and by the network effects of a global trading system built around dollar settlement. What Bessent is now saying explicitly and on the record is that the system built after 1971, the dollar-centric fiat-based post-Bretton Woods architecture, needs to be restructured, and the policy moves his department is making are consistent with that stated intention in ways worth examining carefully. The first move is a deliberate weakening of the dollar. The mechanism is what has been described as a Mar-a-Lago Accord, a reference to Trump's Florida resort and a deliberate echo of the 1985 Plaza Accord, in which the major industrial nations agreed to coordinate a depreciation of the dollar to correct what was then an overvaluation that was damaging American manufacturing competitiveness. The current dollar, by the analysis of the Council of Economic Advisors and others in the administration, is similarly overvalued, strong enough to make American manufactured goods uncompetitive in global markets, to suppress domestic industrial investment, and to sustain the trade deficits that the administration views as the primary evidence of an unfair international trading system. The target depreciation being discussed is significant, somewhere between 20 and 40% depending on the source and the scenario. A dollar depreciation of that magnitude would be the largest deliberate adjustment of the dollar's value since the Plaza Accord. Its effects would be pervasive and asymmetric. Imports become more expensive, which raises consumer prices for goods sourced internationally. Exports become more competitive, which supports domestic manufacturing. Dollar-denominated debt becomes cheaper to service in real terms, and every asset priced in dollars, gold, commodities. Real estate rises in nominal value as the denominator of measurement loses purchasing power. The second policy move is a deregulation of the financial system, a deliberate unwinding of the regulatory architecture put in place after the 2008 global financial crisis. The stated rationale is that excessive regulation has constrained bank lending, disadvantaged community banks relative to large institutions, and prevented the integration of digital assets into the mainstream financial system. The unstated reality is that financial deregulation increases the capacity for credit creation, which is inflationary and increases systemic risk. The 2008 crisis was caused precisely by the kind of leverage and risk-taking that the post-crisis regulatory framework was designed to prevent. Removing that framework does not eliminate the underlying risks. It reallocates them from the balance sheets of financial institutions to the broader economy and ultimately to taxpayers and savers through inflation and eventual bailouts. The third move is the tariff-driven reshoring of manufacturing. The logic is that decades of globalization of locating production where costs are lowest regardless of national origin have hollowed out American industrial capacity, created dangerous supply chain dependencies, and exported the employment base that supports the working and middle class. Tariffs are the mechanism for reversing this. By raising the cost of imported goods, they make domestic production relatively more competitive, incentivizing investment in American manufacturing capacity. The costs are real and front-loaded. Consumers pay higher prices immediately. The benefits are structural and backloaded. Manufacturing employment and industrial capacity rebuild over years and decades if the policy is sustained. Together, these three moves, dollar depreciation, financial deregulation, and manufacturing reshoring through tariffs, constitute a coherent, if extremely ambitious, attempt to restructure the U.S. economy's relationship with the global trading and financial system. Whether it succeeds as designed is genuinely uncertain. What is not uncertain is that the attempt is being made deliberately by the people with the authority to make it, and that its consequences for every asset class are significant and in many cases directional. Let me now explain what this means. For the purchasing power of money, because that is the dimension most directly relevant to ordinary savers and investors. When the dollar weakens by design, when the Treasury and the administration are explicitly pursuing a policy of dollar depreciation, the real value of dollar-denominated savings falls by a corresponding amount. A 20% depreciation of the dollar means that a savings account holding $100,000 has in terms of international purchasing power $80,000 of real value after the depreciation. The nominal balance does not change, the purchasing power does. This is the silent mechanism by which monetary policy transfers wealth, and it operates regardless of whether the individual saver is aware of it or has any opportunity to respond. The historical precedent is instructive. The dollar has lost over 90% of its purchasing power since 1971, since the moment the gold constraint was removed and the government gained the ability to create dollars without limit. The decline was not dramatic on any given day. It was continuous, compounding, and largely invisible to individuals managing their finances on a day-to-day basis. The person who saved diligently throughout the 1970s and 1,980 seconds, keeping their savings in a bank account, earning nominal interest, watched their purchasing power erode consistently because the inflation rate consistently exceeded the nominal interest rate they were earning. The real return on their savings was negative for extended periods. They did not feel poor on any particular day. They felt poor when they tried to retire or when they tried to buy a house or when they compared what their savings could purchase to what they had expected it to purchase. The current policy environment is explicitly designed to accelerate this process. A Treasury Secretary publicly targeting a 20–40% depreciation is a Treasury Secretary publicly announcing a 20–40% reduction in the international purchasing power of every dollar-denominated holding. The hedge against this, the asset class that has historically maintained purchasing power across episodes of deliberate currency depreciation, is not complicated. It is what every civilization used as money for 5,000 years before the 50-year Fiat experiment, physical assets that cannot be created by government decree. Now let me address what the rest of the world is doing in response. Because the behavior of non-US sovereigns is perhaps the most telling signal of how serious this realignment is, the dollar's share of global central bank reserves has fallen from approximately 71% in 2001 to under 58% today. This decline is gradual but consistent, a structural reduction in the proportion of sovereign savings held in the asset that the world's largest debtor issues in unlimited quantities. The BRICS nations, Brazil, Russia, India, China, South Africa, and the expanding membership of that bloc are actively developing alternative payment systems to reduce their dependence on dollar settlement for international trade. The Chinese CIP system is a functioning alternative to the SWIFT messaging network for transactions not involving dollar intermediation, and central banks globally are buying gold, over 1,000 tons last year, record levels sustained across multiple consecutive years. The buyers are not fringe economies or outliers. Poland, China, India, Brazil, Kazakhstan, Turkey, and dozens of others. Countries across very different political and economic systems arriving at the same conclusion about where to hold sovereign reserves in a world where the dominant reserve currency is being deliberately depreciated by its own government, when the people who manage national monetary systems, the officials who understand better than anyone how currencies are created and what determines their long-term value, are buying gold at record pace. They are expressing a view, not a view about short-term price movements, a view about the long-term reliability of the alternative, the dollar-denominated assets that they have been holding for decades as the foundation of their sovereign reserves. That view is that the reliability is declining, that the system built at Bretton Woods and sustained through the post-1971 fiat arrangement, is entering a period of structural transition in which the rules of money are changing exactly as Bessent said, and in which the assets that maintain value independent of any government's monetary policy deserve a larger allocation. Now let me be direct about the two structural scenarios that this transition produces, because they have very different implications and most commentary treats them as if only one is possible. The first scenario is a managed transition. The dollar depreciates gradually over years in a manner consistent with an orderly international adjustment. Manufacturing returns to the United States incrementally. Trade deficits narrow. New trade agreements are negotiated from a position of restructured leverage. Inflation remains elevated but not catastrophic. The Fed adjusts its framework to accommodate the new monetary environment. Investors who hold a diversified mix of assets, including hard assets that hedge against dollar weakness, navigate the transition with their purchasing power largely intact, while those positioned entirely in cash and dollar-denominated savings lose ground steadily. The second scenario is a disorderly transition. The pace of dollar depreciation exceeds what the international financial system can absorb smoothly. Trading partners retaliate against tariffs in ways that escalate into genuine currency wars. Inflation accelerates beyond what the Fed can credibly contain without causing a recession. Credit conditions tighten sharply as financial deregulation produces the excess risk-taking it historically does. Asset prices become volatile in ways that make the transition feel like a crisis rather than a managed adjustment. Investors without preparation lose purchasing power rapidly rather than gradually. History suggests that monetary transitions, the moments when the rules of money change, do not typically follow the managed scenario. The 1971 Nixon shock was not a managed transition. It was a sudden unilateral decision that restructured the global monetary system overnight without international consultation during a television broadcast that interrupted a popular Western series. The consequences, inflation, dollar weakness, gold's subsequent surge from $35 to over $800 per ounce by 1980, were not managed. They were disorderly. The people who were positioned for the transition before it became obvious, who held gold, who owned real assets, who understood that the dollar's gold backing was fictional before Nixon made it officially so, experienced a generational wealth creation event. The people who held cash and dollar-denominated savings experienced a generational wealth destruction event. The current realignment is being conducted more deliberately, more transparently, and with more advanced warning than 1971. Bessent is saying in public what Nixon refused to acknowledge until the moment he had no choice, that transparency is valuable. It gives anyone paying attention the opportunity to understand the direction of the transition and position accordingly before the most acute phase arrives. Let me now give you the three structural risks that I believe are most underappreciated in the current environment and the three corresponding opportunities. The first risk is what I would call the cash trap. Holding wealth in dollar-denominated cash or cash equivalents in a policy environment explicitly designed to depreciate the dollar is not a conservative strategy. It is a strategy that guarantees real purchasing power loss at the rate of dollar depreciation plus whatever inflation is running above the nominal interest rate being earned. A savings account earning 3% while inflation runs at 5% and the dollar depreciates 20% over 3 years is not a safe haven. It is a slow, certain loss of real value. The people who believe they are being cautious by staying in cash during a period of monetary uncertainty are in the specific technical sense the most exposed to the primary risk that the current policy environment creates. The second risk is concentration in dollar-denominated financial assets without understanding the dollar exposure embedded in that concentration. The S&P 500 appears to offer diversification because it contains 500 companies across many sectors, but the index is heavily weighted toward large-cap technology companies that generate significant revenue in non-dollar currencies. A dollar depreciation of 20 to 30% affects the dollar-translated value of those foreign revenues in complex ways, some beneficial, some not, depending on the specific company's cost structure and hedging practices. Understanding the actual currency exposure of a portfolio is not the same as knowing which stocks it contains. The third risk is the timing trap. The belief that the appropriate response to a monetary transition of this magnitude is to wait for certainty before positioning. Certainty never arrives before price. The platinum period of opportunity in any major structural shift is the period between when the transition is visible to those who understand the mechanism and before it becomes visible to everyone. In 1971, the people who bought gold at $35 per ounce in the months before Nixon's announcement captured a move to $800 over the subsequent decade. They did not know the exact timing. They understood the direction of the structural forces. The distinction between knowing timing and understanding direction is the most practically important distinction in investing. The corresponding opportunities are structural rather than tactical. Hard assets, gold, silver, physical real estate, productive land maintain purchasing power across currency depreciation cycles because their supply cannot be expanded by government policy in the way that currency supply can. Gold in particular occupies a unique position in the current environment. It is simultaneously the historical foundation of monetary systems, the asset that central banks are buying in record quantities as they reduce dollar exposure, and the instrument that has historically performed best during the specific combination of dollar weakness and elevated inflation that the current policy environment is designed to produce, domestic manufacturing and energy production represent a genuine structural opportunity if the reshoring thesis is correct. The policy tools being deployed, tariffs, deregulation, energy production incentives, are designed to make domestic industrial investment more attractive relative to offshore alternatives. If they succeed, even partially, the companies and infrastructure positioned to benefit from a sustained reshoring of U.S. manufacturing capacity will see demand growth that current valuations do not fully reflect. Geographic diversification, specifically exposure to economies with strong commodity export bases that benefit from dollar weakness, provides a structural hedge against the specific risk that the U.S. monetary transition creates for dollar-denominated holdings. Commodity exporters receive more dollars per unit of commodity exported. When the dollar weakens, their terms of trade improve mechanically and automatically.